Although higher interest rates and more favorable mortality trends have led to improved conditions for life annuity reinsurance companies, it also has created more competition. Here to discuss a new report, part of AM Best's annual look at the global reinsurance industry, is Stephen Vincent, Senior Financial Analyst, AM Best. And Steve, the report title notes the increased competition in the life re space. What's driving that, and how are these new reinsurers approaching the market?
Well, good morning, John. How are you? As noted in the second report, there is traditional reinsurers are indeed facing increased competition. There's a couple of things that are driving that. Over the last several years, additional competition is coming from new entrants into the market that are seeking to capitalize on some of the challenges that were associated with the post-financial crisis with the low interest rate environment. So that's caused a bit of a strategic shift in the life annuity reinsurance market. In the United States, which is home to the basically the largest, the flagship companies of these large global reinsurers, they've also seen increased competition as well. Offshore reinsurance, especially in the annuity market, has been gaining popularity. They're going to jurisdictions which are more economic, capital friendly, and also lower reserves. And that has partly driven the heightened competition. Demand has softened as direct writers have been able to enhance their balance sheets and also their business diversification, improve their underwriting with greater access to data analytics and better risk tools. So therefore, they are kind of not necessarily looking to use the advantages of the reinsurers that were in place before. And also, direct annuity sales are somewhat crowding out life sales, which in turn is also resulting in lower cessions to the reinsurance market.
Now, the life free market historically has been top heavy, a handful of dominant companies. How have they responded to the influx of new entrants?
Well, in the past, these traditional reinsurers focused on biometric risks. So you think about the idea of writing a yearly renewable term type of treaty for life insurance. In response to these new entrants, there's also been softening demand as reinsurers are doing basically several things to combat that. They are looking to invest in innovation and services. So they once again are differentiating their offers from the direct writers who have kind of upped their game a little bit. So they're looking to, be able to offer more competitive pricing from that perspective with better data as well. So they're all kind of using that from a competitive standpoint. And they're also looking to have better risk selections than their reinsurance competition as well. So, for example, revenues are coming from providing expertise with partnering with seeding companies to help them break into new markets or new distribution spaces, looking to refine their underwriting methods, and they're also looking to basically compete with competitors in the direct space. And secondly, they're also basically relying on retrocession, which is basically reinsurance for reinsurers, to help them to pass on some of the risks that they have and also to help with capital enhancement for their balance sheets.
Do you have any concern about the viability for long-term PE or asset managed owned reinsurers to be able to stay in the market?
Well, I would think worry is a strong word. Traditionally, private equity capital is expected to help finance growth. They commit the capital for a relatively fixed short horizon, like maybe 5 to 10 years or so. And reinsurance sidecars is a concept that it's a structure that's helping to facilitate these flows into these deals. It provides timely capital to match up with the growth in the liabilities. So while the original equity was expected to be in for a short period of time, that matches up pretty well with some of the annuity business that's being written. If you think about that, they want to be in the in the place for 5 to 7 years or so. That matches up pretty well with the maturities of some of these multi-year guaranteed annuities, which are basically like a 5 to 7 year guarantee. But anyway, the private equity owned companies, reinsurers will still need to continue to find capital to continue to stay in the market. Because once that original capital goes, basically they're looking for somebody else to come in and replace it. So I do see the successful companies doing this, getting to a certain scale. Effectively, scale might be in the range of maybe potentially as high as $5 to $10 billion a year in annual premiums. Now, there have been several high-profile insolvencies in the offshore space, and that really does emphasize the counterparty risk. So that's kind of maybe not as much of a worry, but more of a concern. So these private equity firms that are backing the new entrants, they tend to be more aggressive and risky in their investments. So they kind of come in and they want to utilize the expertise of the parent. And so they're writing more structured products, more private credit and alternative asset classes. So if there's anything from a concern standpoint, it's kind of that counterparty risk. You want to know who you're dealing with and that they're going to be there.
Steve, how do you expect this segment to perform over the next year or so?
Well, I think one of the things that has caused the conversation in this space is annuity growth. Annuities are growing, better than 10% a year. So I expect that annuity growth to continue. RILAs are a hot product in the annuity market. So I expect the opportunities for traditional reinsurance where they can offer their expertise to companies looking to potentially break into new product spaces. Unique investments that line up well with the liabilities are going to probably perform reasonably well in the short term. I also expect that there'll continue to be more formations with private equity in this space. They'll continue to look to find opportunities. And these private equity developments, they're definitely going to put stress on the regulators. I mean, these items are going offshore. There's more of them. And the regulators are going to have to keep up with the diversity of these private equity firms, for example, that are coming in. So again, that really just goes back to emphasizing the counterparty risk involved.
Thanks, Steve.
Thank you.
That was Steve Vincent, Senior Financial Analyst for AM Best. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.